Ladies and gentlemen, Asian guy here. We need to talk about infection. We need to talk about how a virus spreads. Not a biological virus, but a financial one. A contagion of repricing that starts in a small, neglected corner of the market and aggressively infects the entire periodic table of elements. For the last few weeks, we have been obsessed with silver. And rightfully so. Silver is the patient zero. Silver is the spark. But if you think this story ends with silver, you're missing the forest for the trees. You're missing the biggest investment theme of the next decade. You are missing the Commodity Supercycle. You have to understand the architecture of the banking desks that control these prices. The precious metals desk at JP Morgan or Citi isn't just one guy trading silver. It is a complex ecosystem. It is a machine. And that machine uses the same pool of capital, the same collateral, and the same algorithms to suppress gold, platinum, palladium, and even industrial metals like copper and uranium. They are all connected. They are all Siamese twins joined at the hip by the balance sheet of the bullion banks. And this is why the silver squeeze is so dangerous for them. It is not an isolated event. It is a breach in the hull of a submarine. When water rushes into one compartment, it weighs down the whole vessel. Let's look at the mechanics. When a bank gets a margin call on silver, like the $17 billion nightmare we discussed, they lose liquidity. Their value at risk, own VAR models, blow up. The risk managers step in and say, "You're overexposed. You need to reduce risk across the board." They don't just say, "Cover the silver shorts." They say, "Deleverage the entire book." Because the bank is bleeding cash, they can no longer afford the margin requirements to hold massive short positions in gold. They can no longer afford to spoof the platinum market. They can no longer suppress uranium, so they have to buy back their shorts, everywhere, simultaneously. This is the short squeeze rotation. The pain in silver forces them to lift the boot off the neck of gold. The pain in gold forces them to retreat from platinum. It is a domino effect. One falls, they all fall, and the market smells blood. The hedge funds, the sharks, they see the bank is wounded. They see the bank is retreating from silver. They think if they are too weak to defend silver, maybe they are too weak to defend platinum. So they attack platinum, they buy calls, they demand delivery. This creates a multi-front war for the banks. They are being attacked on the silver front, the gold front, the platinum front, and the uranium front all at once. And just like any army fighting a multi-front war with limited resources, they eventually collapse. They have to choose which battles to fight, and eventually they have to surrender them all. This is the contagion. It spreads from the monetary metals, silver, gold, to the industrial metals, platinum, copper, to the energy metals, uranium. It is a repricing of stuff versus paper. It is the realization that the dollar is losing value against everything tangible. Let's start with the most obvious contagion link: gold, the big brother, the king. Gold and silver trade in tandem 80% of the time, but recently, the gold to silver ratio has been stretched. Silver has been the leader, but gold is the deep market. Gold is where the central banks hide. When the silver squeeze breaks the confidence in the paper derivatives market, that loss of confidence transfers instantly to the gold market. The same investors holding unallocated silver accounts are often holding unallocated gold accounts. When they see the silver market fail to deliver, they panic and demand their gold. We are already seeing this. The premiums on gold eagles are rising. The vaults in London are seeing outflows. The buck run on the bank in silver is actually a run on the bank for all precious metals. The contagion is psychological. If I can't trust the bank with my silver, I can't trust them with my gold. But the contagion goes deeper. It goes to the very nature of how these metals are mined. Most silver is a byproduct of mining for other metals: lead, zinc, copper, gold. If the price of silver rips, the economics of these mines change. But more importantly, the capital flows change. Investors who make 500% gains on silver don't put that money back into cash. They are hard asset investors. They take their profits and they rotate. They look for the next undervalued asset. They look at platinum. They see it is trading below the cost of production. They see the supply deficit in South Africa, and they pour their silver winnings into platinum. This rotation of profits accelerates the contagion. The money stays within the hard asset ecosystem. It creates a self-reinforcing loop where the rising tide lifts all boats, and then the boats start racing each other. We saw a preview of this in the 1970s. Silver moved first, then gold, then oil, then uranium. By 1980, everything was in a bubble. But this time, the fundamentals are even tighter. The deficits are real. The inventories are lower. We are going to dissect each of these markets, gold, platinum, uranium, and show you exactly how the silver squeeze triggers their specific explosion. We are going to look at the short positions, the physical deficits, and the geopolitical triggers. The banking cartel is terrified of this contagion because they are short everything. They have been shorting reality for 40 years. They bet on financialization. They bet on paper. And now reality is calling the bluff. When you look at your screen and see silver up 5%, don't just smile. Look at platinum. Look at gold. Look at the miners. Watch the infection spread. Watch the red turn to green across the entire sector. The firewall has been breached. The virus of true price discovery is loose, and there is no vaccine for a market that has been suppressed for this long. The immune system of the cartel is failing, and the fever is about to spike. Now let's focus on the big one, the heavyweight champion of the world, gold. For a long time, the silver squeeze community has had a bit of a rivalry with the gold bugs. Silver is the squeeze play, we say. Gold is the boomer rock. And mathematically, that has been true. Silver is smaller, tighter, and more explosive. But make no mistake, gold is the ultimate target. Gold is the heart of the beast. The banks suppress silver largely to keep gold in check. Because if gold goes, the dollar dies. Gold is the report card of the Federal Reserve. Silver is the volatile little brother that warns you the report card is coming. Here is how the silver contagion infects gold. It is a mechanism of arbitrage and liquidity. The gold to silver ratio, GSR, is the key. Currently, it is hovering around 80.1 or 75.1. Historically, it should be 15 to 1 or maybe 30 to 1. When silver rockets higher, that ratio collapses. Let's say silver goes to $50. The ratio drops to 40.1. The algorithms that trade these markets, the high-frequency trading bots, they are programmed to trade the ratio. When the ratio deviates too far from the mean, they step in. If silver gets expensive relative to gold, the bots sell silver and buy gold to close the gap. This algorithmic buying acts as a massive tailwind for gold. As silver squeezes, it drags gold up with it via the ratio trade. The banks know this. They know they cannot hold gold down if silver is ripping. It is like trying to hold a beach ball underwater while the tide is rising. But there is a more direct contagion, the short covering. The commercial banks, the swap dealers on the COMEX commitment of traders' reports, hold massive net short positions in gold futures. Not as large as silver relative to production, but huge in dollar terms, billions and billions of dollars. As the silver losses mount into the tens of billions, the banks face a liquidity crisis. We discussed the repo market spike. They need cash. They need to reduce VAR. They look at their gold shorts. They're underwater. Gold is pushing all-time highs. They're terrified that the momentum from silver will spill over. So they cover. They buy back the gold contracts. This is short covering. It is forced buying. It has nothing to do with fundamentals or jewelry demand. It is pure financial survival. When the banks cover their gold shorts, they remove the ceiling from the market. The suppression mechanism is turned off because the suppressors are broke. And then there is the geopolitical contagion. The central banks of the world, China, Russia, India, Turkey, they are watching the silver squeeze. They see the U.S. banking system struggling. They see the weakness. This validates their decision to dump dollars and buy gold. China has been buying gold for 18 months straight officially, and probably 10 years straight unofficially. When they see the silver market breaking, they know the U.S. dollar is vulnerable. They accelerate their buying. They want to convert their trade surplus into hard assets before the price resets. So you have the banks covering shorts on one side, and the sovereign nations buying physical on the other side. This is the perfect storm for gold. The floor is being raised by the central banks, and the ceiling is being blown off by the insolvent commercial banks. And let's not forget the retail investor. The contagion spreads through sentiment. When silver is in the news, when silver squeeze is trending on Twitter, people think about precious metals. The average person might not know where to buy silver, or they might think silver is too heavy to store, so they buy gold. Costco selling gold bars is a prime example. They sell out in minutes. This is retail contagion. The normies are waking up. They see inflation at the grocery store. They see the silver headlines, and they panic buy the most recognizable asset, gold. This creates a shortage in the physical gold market. The premiums on gold coins rise. The spread widens. And just like in silver, the COMEX gold vaults start to drain. The registered gold inventory has been falling. The leverage ratio is rising. Gold is a much deeper market than silver, so it takes more money to move it. But the money moving out of the bond market, the doom loop, is infinite. When trillions of dollars flee treasuries, they don't fit into the silver market. The silver market is too small. It would overflow instantly. So the overflow goes into gold. Gold is the only asset class big enough to absorb the exodus from the bond market. The contagion from bonds to gold is the final step in the dollar's demise. We will see gold move to $2,500, then $3,000, then $5,000. And unlike silver, which can be volatile, gold's move will be relentless. It will be a grinding, unstoppable ascent that crushes the shorts slowly and methodically. The silver squeeze lights the fuse, but the gold explosion is the bomb. The banks can maybe survive a silver spike. They can write it off as a commodity glitch, but they cannot survive a gold revaluation. Gold is money. If gold goes to $5,000, the dollar is officially devalued by 50%. The credibility of the Fed is gone. So the contagion to gold is actually the contagion of truth. Silver tells the truth first. Gold confirms it. And once gold confirms it, the entire financial system has to reset. Now, let's move to the most undervalued asset on the planet, the forgotten metal. The metal that is 30 times rarer than gold, yet trades at half the price. Platinum. If silver is the people's money, platinum is the industrial aristocrat. It is essential for catalytic converters, for hydrogen fuel cells, for the green energy transition, and it is in a massive structural deficit. Here is the contagion mechanism for platinum. It is partially financial and partially geographic. First, the financial contagion. The same banks that short silver, specifically the New York and London desks, manage the platinum group metals, PGM books. Platinum is a thin market. It is illiquid compared to gold. It is very easy to manipulate with paper, and they have hammered it down for a decade. Why? To keep the cost of cars cheap? Maybe. But mostly because it's an easy trade. But now the liquidity crisis hits, the banks are pulling back, they stop shorting, and suddenly platinum is free to float. But the real contagion comes from the rotation of the silver squeeze army. The smart money in the silver community, the guys who have been researching this for years, they know the platinum story. They know that platinum used to trade at a massive premium to gold. In 2008, platinum was $2,200 and gold was $1,000. Today, platinum is $900 and gold is $2,400. This inversion is a historical anomaly. It is a coiled spring. When silver investors take their profits at $50 or $100, they will look for value. They will see platinum trading at literally half its production cost in inflation-adjusted terms. They will pour billions into physical platinum and the platinum ETFs, like PPLT. Since the platinum market is so tiny, annual production is only about 6 million ounces compared to 800 million for silver, it takes very little money to squeeze it. If just 1% of the silver profits rotate into platinum, the price doubles overnight. Now, add the geographic contagion. Where does platinum come from? 70 to 80% comes from South Africa. South Africa is a BRICS nation. It is aligning with China and Russia. It has a crumbling energy grid, Eskom. The mines are shutting down because they don't have electricity. The supply is collapsing. Meanwhile, the demand from the hydrogen economy is exploding. Fuel cells use massive amounts of platinum. If the world is serious about net zero, platinum is the most strategic metal on Earth. The banks know this. They know they are short a metal that is running out, but they have been trapped in the trade. The silver squeeze forces the liquidity crisis that breaks their grip. They have to cover their platinum shorts at the same time the physical shortage hits. It is a double whammy. Financial covering plus physical shortage, super spike. We could see platinum pull rhodium. Remember rhodium? It went from $600 to $29,000. Why? Because the car companies needed it and there wasn't any. Platinum is next. The contagion spreads to the auto industry. Ford, GM, Toyota. They rely on the futures market to hedge their platinum costs. If the futures market breaks, force majeure, they have to panic buy physical. This industrial panic buying is exactly what we are seeing in silver, but in platinum, the door is even smaller. And let's talk about the substitution effect. In catalytic converters, you can use platinum or palladium. For years, palladium was expensive, so they switched to platinum. Now palladium is crashing, thanks to Russia, sanctions, and demand shifts. But platinum is the preferred metal for the hydrogen future. The green contagion. The push for clean energy is a push for platinum. The silver squeeze validates the thesis that hard assets are scarce. Investors realize that the green transition cannot happen with paper contracts. It needs metal. So platinum becomes the next battleground. The Reddit forums will light up with platinum squeeze. The tightness in the lease rates, the cost to borrow platinum, is already rising. This is the signal. The borrow is getting expensive. The shorts are trapped. When platinum breaks $1,100, it clears the multi-year resistance. It has clear skies to $2,000, then $3,000. It will reclaim its throne as the rich man's gold, and the banks shorting it will be carried out on stretchers. The contagion here is one of value recognition. The silver squeeze wakes people up to the reality of manipulation. Once they see the manipulation in silver, they look for it elsewhere. They find it in platinum, and they attack. Now we enter the nuclear zone. Uranium, the most asymmetric trade in the world. The metal that powers 10% of the world's electricity and 20% of the US grid. You might ask, John, what does silver have to do with uranium? One is money, one is fuel. Everything. They are connected by the Commodity Supercycle and the physical versus paper war. The banks that trade commodities, Goldman Sachs, Macquarie, they trade the uranium spot market and the uranium trusts, like SPUT. But the contagion here is mostly psychological and structural. The silver squeeze is a revolt against paper promises. Uranium is the ultimate physical reality. You cannot print energy. If you run out of uranium, the lights go out, period. The uranium market has already been squeezed. The Sprott Physical Uranium Trust, SPUT, started buying physical pounds off the market, cornering the supply. This is the exact model that silver investors want to see. SPUT proved that if you sequester the physical, the price goes up. The contagion from silver acts as an accelerant. As the dollar collapses due to the bond market doom loop, the price of energy in dollars skyrockets. Uranium, priced in dollars, goes vertical. But there is a deeper link: the mining capital. The same investors who own silver miners often own uranium miners. It is the same resource contrarian crowd. When silver stocks go up 500%, that capital creates a wealth effect. These investors feel rich. They look at their uranium stocks and say, let's double down. This flow of capital from silver winnings into uranium developers allows new mines to be built, yes, but in the short term, it creates a buying frenzy in the uranium equities, URA, URNM. This draws mainstream attention. And the banks, they are short the energy transition, because they bet on cheap renewables. They bet against nuclear. Now, with AI demand for electricity soaring, nuclear is back. The data centers need baseload power. Only nuclear can provide it. The silver squeeze exposes the fragility of the just-in-time supply chain. Utilities, the buyers of uranium, watch the silver users panic. They watch Tesla panic over silver. They think, wait, what if we run out of uranium? Utilities are conservative. They panic slowly. But when they panic, they buy huge amounts. The silver squeeze creates a security of supply mindset globally. Every purchasing manager in the world is suddenly terrified of being short. So the utilities rush to sign long-term contracts for uranium. The price creates a floor at $90, then $100. The spot market thins out. And then there is the Russia connection again. Russia controls a huge chunk of enrichment. The geopolitical bifurcation that drives gold and silver also drives uranium. The West needs to secure its own supply. The contagion is the realization that strategic assets are finite. Silver is strategic for electronics. Uranium is strategic for survival. The market reprices strategic from a discount to a premium. We are seeing the formation of a hard asset block. Silver, gold, platinum, uranium, they are moving together against the fiat currencies. The correlation goes to 1. The banks cannot suppress uranium easily because there is no futures market like the COMEX. It is mostly long-term contracts. But they try to suppress the sentiment via equity shorts. But when the silver squeeze breaks the shorting algo, the uranium shorts cover too. The uranium squeeze will be violent because the market is tiny. The entire market cap of the uranium sector is less than one large tech stock. If the silver money rotates in, it's like trying to pour the Hoover Dam through a garden hose. The price has to explode to accommodate the flow. We have looked at the pieces: silver, gold, platinum, uranium. Now let's put the puzzle together. This is the commodity supercycle. This is the everything bubble in hard assets. For 40 years, we had a supercycle in financial assets, stocks and bonds. That cycle ended in 2022 when rates started rising. Now, capital is flowing out of the $500 trillion financial balloon and trying to squeeze into the $10 trillion commodity balloon. The contagion is the mechanism of this flow. It starts with the weakest link, silver, and spreads to the core, gold, and the industrial base, platinum or uranium. This is not a coincidence, it is a cycle. The Kondratiev wave, the fourth turning, whatever you want to call it. It is the turning of the tide. The paper era is ending. The resource era is beginning. The banks are on the wrong side of history. They are short the future. They are short the resources needed to build the future. And the silver squeeze is the margin call from the future. When this supercycle fully engages, we will see things we haven't seen since the 1970s, or maybe the 1920s in Germany. We will see commodities rising 20%, 30% a month. We will see shortages on the shelf. This creates a positive feedback loop for inflation. Higher commodity prices draw higher CPI. Higher CPI triggers weaker dollar. Weaker dollar. Higher commodity prices. The Fed tries to fight it, but they are trapped by the doom loop, bond market. They have to print. The printing feeds the supercycle. For the investor, the strategy is clear. You don't have to pick just one. You own the basket. You own the inflation lifeboat. Silver for the squeeze, gold for wealth preservation, platinum for value, uranium for growth. They are a team. They are the Fantastic Four of the collapse. And they are all undervalued relative to the Dow Jones, the S&P, and real estate. The ratio of commodities to equities is at a 100-year low. It is practically touching the floor. The only way is up. The reversion to the mean will be the greatest wealth transfer you will ever see. The contagion ensures that you cannot contain the fire. If the banks try to stomp out the fire in silver, it flares up in gold. If they stomp on gold, it flares up in uranium. They don't have enough boots. They don't have enough water. The system is rigged, yes, but it is rigged for a specific set of conditions. Low inflation, high trust. Those conditions are gone. The rig doesn't work in a hurricane. We are entering the hurricane. The silver squeeze is the first gust of wind. The gold rally is the storm surge. The platinum and uranium explosions are the destruction of the old infrastructure. So, do not look at these as separate trades. Look at them as one single trade. Long reality, short fantasy. The contagion is your friend. It confirms your thesis. It diversifies your risk. It amplifies your gains. The banks are terrified because they know the math. They know that once the confidence domino falls, the rest fall by gravity. And gravity is undeniable. Get your position. Diversify across the hard assets. Watch the screens turn green. Watch the panic on CNBC. Watch the contagion spread. And know that you are inoculated because you hold the cure. Physical reality. I am John A.G. The virus of truth is spreading. The banks are sick. And the commodities are breaking out of the ICU. It's time to ride the supercycle.